Good morning, guys, and welcome to the Croissant Files Live again. This week will be a little bit different. We have this new section at the end of the show, which will be the market dashboard where I will, disclose, expose some of the things that I look at on a daily basis. It's just an embryo of what I'd like to be doing going forwards about the market. I'd like the market to take a bigger place, more on a quantitative basis, to show you not what only the markets are doing with chart, but how the markets are behaving with more quantitative insight, which more relates to what I do anyway, and it's a little bit more exciting to me. So I'd like this part at the end of the show to take a longer part, which means that in the future I'd like to shrink both the geopolitics and the economy part. The economy part potentially is the one that I will shrink the most, because this is the one I'm not really excited about. Meaning, the reason is that the economy and the markets are driven by basically two big things, which is the cost of money, interest rates, defined by inflation, government debts, that kind of thing. And the second part is the cost of energy. Once you have covered the cost of money and the cost of energy, you have basically the global picture of the economy. Obviously, it will not cover anything, like housing, for instance, but which is directly related to interest rates anyway. And economic activity, basically it's energy and money to put that energy into motion to build something. So that's probably what I will be focusing on the future about the economy. The geopolitics will be probably my biggest problem to shrink, because I always find it very interesting, and I'm really passionate about that. This has so many impacts on every aspect, from our daily lives to the economy itself. So this is where I'm going in the future, so I will try not to waste too much time at the beginning, and start now to save some time for the end of the show and the market dashboard. See how it goes. I would like you to make some comments specifically about the market dashboard at the end, just to get an idea of what you find interesting, what you don't find interesting, what you find useless. That can happen as well. And if something is not present, what you'd like to see in the market dashboard. And I would like to be able to put my spin on it, and share my reflections. So let me check if there are some comments already. Not yet. There are a couple of people here that I can see on LinkedIn. So let's go. So we'll start as usual with geopolitics. So geopolitics, what did happen this week? Pretty significant stuff. I will start with the audit of gold at Fort Knox. Nobody knows how much gold there is. The last real audit was in 1953. The kind of a show audit was in 1974 with journalists, with I think there was TV Star or that kind of stuff. Well, something that was kind of useless, was just to show the population that the gold was still there, probably after Nixon abandoned the gold standard. So it's okay, we still keep our gold. Kind of that message. Since then, nothing really happened. The only thing that was checked was the seal on the doors of the vault, and not much more than that. So Elon Musk and Trump seems to be on board that they will check the gold in the vault, with potentially live streaming of it. That should be really interesting. A lot of attention will put to this. But anyway, I think that the point is to re-establish the supremacy of the US dollar. There are two options at this point. There is no gold anymore, and well, not as much as expected. And in this case, that would trigger a massive, reaction probably on the market. So the only solution that I think that will happen if this is the case is that Trump has a plan for that, or this is an opportunity for him to break everything and to rebuild. But I don't think so. Or the second option is that there is still gold, the expected gold in the vaults, and that would reassure the markets and the world about the backing of the US dollar. And that goes also where a lot of gold being repatriated from foreign countries such as the UK, even Switzerland has been sending gold to the US, which means that probably the US wants to say, now we have our gold, we have even more than that, and the US dollar is still the reserve currency of the world. So I think that would be the first step to reestablish the supremacy of the US dollar. We know how important this is for Trump, and I think that Bitcoin would come in the second step. That's the logical path to Bitcoin as a reserve for backing the US dollar. We'll see what happens, but I might be totally wrong, obviously, but my guess is that they already know the outcome of such, what's inside the vault anyway. It's impossible that they disclose without knowing actually what it is. This would be too much of a gamble. And my belief is that the goal is still there, and they say with the gold repatriation that we have more gold than actually expected. So believe us when we say that the US dollar as the reserve currency of the world is here to stay. My other point is that about gold is that it's potentially another sign of the abandon of Europe, especially considering gold being repatriated from the UK. But I think we will see that slightly later in the show. So what happened this week? So the big, geopolitical info was the start of discussions between Russia and US about Ukraine. US was not Ukraine. The Ukraine was not invited. There was a delegation. I mean, there was a kind of misunderstanding, because there was a delegation, Ukrainian delegation in Saudi Arabia, but Ukraine was not invited to the talks. Nor the Europeans were invited. So it just they didn't care about saving the appearances. I say, okay, I mean, you don't matter, and we are dealing between adults in the room. I mean, adults, we are the strongest guys. That's what we mean, and what you think that doesn't care. So that's a big slap in the face for Europe, and a big slap in the face for Ukraine. Because what Trump wants to do is to reestablish the supremacy of the US, both in terms of reserve currency, but in terms of dominating country of the world, and specifically against its European vassals. I've always said that Europeans position themselves as vassals of the United States. And this is exactly what the US is telling them right now. But they did this to themselves by specifically France, by joining NATO in 2007 to save on military costs. And once you abandon your military and your sovereignty, that's what you become a vassal. But anyway, this is what happens. I mean, so the talks, were pretty successful from both sides, considering from both sides, because there seems to have an arrangement that is is okay with actually both parties against Ukraine. One of this will be, so Ukraine basically, as it was before, will not exist anymore. So the Russia didn't want NATO because they didn't want missiles, foreign missiles at their border. Ukraine will never be in NATO. Russia will get the eastern part of Ukraine, the ones that they are occupying now, and on the U.S. side, will get its money back. That's what Trump's want. And so Trump, disclosed a plan that is very difficult to swallow, specifically for Ukraine. I have the list of the thing here, but it will be very difficult for them because it will be the equivalent of the Versailles Treaty that happened after the end of World War I, where Germany, they have to face huge reparation costs for World War One, and so the Germany was bankrupt. This led to massive inflation, hyperinflation of the Weimar Republic at the time in the 30s, and then led to the accession of Hitler to power. So this is the kind of deal where the US will get some reparations back. How they will get it? They will get it in terms of minerals from Ukraine, even from the Russian eastern Russian region that will be from Russia. I've seen this morning that it seems that Russia and the US have come to an agreement where the US will be able to exploit some minerals in the Russian regions of Ukraine. So basically both are happy because they will get what they want from Ukraine. That will never exist as it was before. And like I said, in the past shows, the issue is that Ukraine lost everything in this and more by being pushed to war by the former administration and the European countries in a conflict that, I said at the beginning in 2022 that it was a conflict that Ukraine could not win. So of course, some will say, well, if Ukraine only lost because Trump was elected, and you can think that, but I still believe it's not true. I mean, what Trump is only doing is accepting the fact and the situation on the ground. And I believe that the ones that say that just need more weapons, more things, are just totally delusional. The population in Ukraine is 40 million people. The population in Russia is 140 million people. So the imbalance of fighters, and that's basically what I said from the beginning, as long as there's no direct involvement in the conflict from Western countries by sending men, not only weapons, the math just doesn't add up. So from the talks, there were many takeaways from there. So there is a new U.S.-Russia dialogue from opponent of Trump will say again Trump is a puppet of Putin. Obviously, that will be the narrative. Now Russians are asking for the removal of the sanctions by the US. Under delusion by Europe. Europe is saying that they will not lift sanctions against Russia. That will only hurt Europe as well. So that's there's a lot of let's say news. There's a lot of unfolding at this time, both from the US Russian side and the European side. We don't seem to understand what's happening to them at this time. No, not this. When I was so okay. Um, so what can I say about this? Not much more. Uh, Not much more, but so the Europeans don't seem to understand their position at this time, and well, don't really seem to be understanding, but they certainly somehow understand that now they are on their own. And you had, this JD Vance speech at the Munich Security Conference last week, who will basically tell them in front of them the truth that Europe is setting up itself like the big democratic thing when it's not. So I've put a couple of news here where you have people, you have the thought police basically in Europe at this time. You have journalists fined because they were mocking, Meloni's height. You have German Chancellor, a man who was investigated by calling the German Chancellor an idiot. In the UK, you have people being arrested for things that they are posting online, but they are calling this democracy and fighting against anti-democratic people. Fortunately, in the US, we have the First Amendment, which is really the bedrock of democracy. It's my opinion. But it was. The Europeans were really shocked about JD Vance speech last week, and that's how they understood that they were on their own. And but so there is this speech of JD Vance, but at the same time, Vance told them that they did that to themselves, but at the same time it plays under the game of the US by forcing Europe, imposing sanctions to Russia, blowing up Nord Stream, cutting Europe from the cheap Russian energy. That was the game plan from the US from the beginning. So yes, Europe is responsible for what happened to them, but definitely the US helped. So we had a lot of reactions from European politicians, and again, like I say, needless that I say, so I've looked at European news and I look at the French news, and if you watch the French TV, the French foreign secretary, that's what you saw, a minister of foreign affairs, something like this. I don't know exactly how to translate this in English. He said that if they would get a call from Russia, the guy would not even take it. It's just being totally delusional about the position of Europe in the global, I would say, world chessboard, to paraphrase Brzezinski, for instance. So the consequence for Europe are really heavy. Because again, it's now you're on your own with the Ukraine. You will also pay for reconstruction, but it will be US companies that will be doing the reconstruction. You'll have to increase your military spending because you'll have to deal with Russia yourself if you want to protect yourself. Ukraine will never be protected by Article 5 from NATO, and if you go and get involved militarily in Ukraine, such as peace forces, like some of them mentioned, even Stramer in the UK said that he will send troops in Ukraine. The US said that these troops and the countries sending troops there will never be protected by the Article 5 of NATO. And at the end of the day, the US will never send any troops in Ukraine anyway. and you won't be able to buy some cheap energy from Russia. You'll still have to buy all expensive natural gas from the US. This is the US saying, you have nothing to say, we tell you what to do, and just shut up. That's basically what it means. So obviously it was, again, I mean, I will never say this again, because this is what I've seen the whole week about Europe, and what I've seen in the European news. The Europeans are in shock and they have no idea how to deal with the situation. Such no idea that after the talks between Russia and the US started in Saudi Arabia. On Monday, the next day, on Tuesday, Macron launched, an emergency summit for peace on Ukraine. But they can do all the summits they want. Nobody asks them. Nobody cares about what they think anyway. And just to add to, again, the delusion from European, you still have von der Leyen, which again has never been elected by anyone, said that the peace can only be made on the basis of strength against Russia. I think she has no idea what she's dealing with, and I believe it's total insanity. So again, I don't know what to say much. I mean, there will be much more to say, about democratic status of Europe. When JD Vance, for instance, tell them you cancel for democratic countries, for supposedly democratic institution like the European Union, you cancel the Romanian election just because you didn't like the results. And this is kind of where we are going, specifically in Germany. Probably if the right-wing party, the AfD, is winning the election that are happening this weekend. So that will be, again, for the status of democracy in Europe, to see what happens if this right-wing party wins this weekend. So let's switch to the economy. I've not been much faster than usual. So maybe here. So just a transition between geopolitics and economy. You already have big names like the likes of Zara, Bershka, Pull&Bear, Stradivarius. They are already preparing their return to Russia. And they are already in negotiation, by the way, where some of these, big store chains will simply regains what the stores they had left before the beginning of the war. Some of them are occupied by new, smaller Russian chains. Some of them not even occupied, so they will be able to go back rapidly. But that's just anecdotal at this point. But this will probably change very rapidly. Point of the U.S. debt, we are at a point where the U.S. debt will be bigger than the World War II era, in a situation where where the U.S. is officially not at war. So you see the projections are going way beyond. This is a snowball effect that seems that cannot be stopped. And when you are sending massive debts in the market, what do you get? You get inflation, and inflation is back again. So I mean, this is simply the worst situation that we can get. So because I will talk about this right after that. There is a let's say white collar recession where employment, even for white collars, is not good, and is not really recovering massively. The white collars have lost jobs over the last year. about 250,000 jobs since May 2023. And the sector of, what sector, if we can call this, but white collar sector, let's say, contracted for the 17 months straight, and this has never happened in outside a period of recession. So we have a situation where we'll have kind of a stagflation. You have no growth, or virtually no growth when it's not supported by debt, no growth and inflation. That's the worst that can happen to the Fed, and something that you can barely deal with, actually. So besides that, we have Doge that is trying to cut all the expense to save what can be saved. And you have these statistics, the number of living Americans in Social Security database. Not only the Social Security numbers were not double counted, you have the same Social Security number for multiple people receiving benefits, but at the same time we have people that are 170 that are still listed in that Social Security database. Some of them probably receive benefits. Obviously they don't, but some do. We have, in France there was a similar situation where you had immigrant population that went to France in the 70s, 80s to work and went back to retire in Algeria, for instance. And in Algeria you have people, 200 more than 100 years, and some of them are 150 years like this, and the country is still sending benefits to them. Obviously they are not them to collect it, not here to collect it, maybe one or two exceptions, but the families still get the money. And this is another kind of fraud. So I was surprised to see that it was happening as well in the US. Maybe a little bit of international comment on the economy. So you see that the German economy growth never returned after pandemic, but the pandemic also coincides more the flattening with the beginning of the war in Ukraine, when Europeans starting implementing sanctions against Russia. And I've said that 1,000 times that they lost access to cheap energy from Russia, which hurt the European industry, and specifically Germany, which the last industrial country in Europe. So as long as they don't get cheap energy back, it will be very difficult for them to recover a trend of growth. And I believe that, my opinion is that, France and Germany have two opposite positions in Europe. Germany is the industrial country and needs cheap energy from Russia, and France is the last, let's say, military country, quote unquote. Why? Because this is the last one with an actual army or an embryo of army, but France has the nuclear weapon, which all other, this is the only country in Europe who has a nuclear weapon. So you have Germany industrial, you have French which wants to take the military role, and if you want to have a military role, you have to need an enemy. And the current, obvious enemy for Europe and France is Russia. So you have, kind of a discrepancy here between views, potentially between Germany and France, which will have to be resolved. And based on everything that I've said before, in terms of geopolitics, I think that the US is putting the Europeans into a position where they will never be able to pay back the debt anyway, which will create tensions in Europe, and that may lead to the explosion of the European Union and potentially the explosion of NATO. So, I mean, that's a risk actually for Europe at this time. Well, nobody cares about myself, but anyways. Meanwhile, we have Japan's inflation that is climbing, which is a risk for interest rates in Japan, and the carry trade that we've seen over the past year. And I mentioned this last week, when we have Japanese rates going up and Swiss rates going down, which again may introduce a shift in the currencies used for the carry trade. And at the same time, we have in China developed the world's first lithium battery tech to extend lifespan by decades, which is a very significant improvement for potential electrical vehicles, and basically goes against the planned obsolescence that we have in our capitalistic countries, where the idea is to make you consume the most, consumers consume the most as possible. That's how the economy works on all sides. So this basically, I think, what I thought was interesting is that it kind of undermines the Western model, specifically with these two news. We had DeepSeek 2 weeks ago say, okay, you invest billions in some stuff that we can do for millions only. You have batteries that don't last much long and is a huge cost for your consumer. We can do that, with longer lifespan batteries that will be much more useful. So I think that's another way to, undermine the Western economy. I think that's interesting. The other thing that I've seen interesting, and something that could save actually Europe, I mean, if it works, but it's a much longer term, 20 years, I believe at least. That China is working on nuclear fusion to produce electricity. If that works, I mean, the issue of energy in the world will be solved. They were pretty advanced, but in France, it was yesterday that I've seen the news that France managed to extend what the Chinese had done by 20%. They can run, generating that kind of nuclear fusion for me. I don't remember exactly. It might be 22 minutes, something like this, which is a huge improvement compared to what China is doing. So if Europe can do something like this, again, the point is access to cheap energy. Interest rates, energy, that's basically what you need to know about the economy. So yesterday we had something happening that was, so the top, again, I need to think all the time. So the top right, you have inflation expectations and economic activity shrinking. So that's another way to see inflation. Maybe I can show you that a little bit bigger. You've seen that since Trump was elected, you have economic surprise that is on the way down, specifically yesterday, with the numbers that we had that were not really good. Do you have anything more about this actually? After that, no, maybe not. So I can tell you on this slide. So economic surprise went down pretty significantly yesterday. Yesterday there was quite few numbers coming out, few statistics that were not positive for the U.S. economy. Again, the expectations for inflation by the University of Michigan jumped dramatically. You have the PMI data that was not very good, and the housing data that was bad as well. So that sent, that already weakened the market yesterday, not to mention the news about a new coronavirus that, hit the market yesterday around, let's say, midday East Coast in the US. So yes, a lot of happened actually. So we were on our way down to interest rate cuts expectations. Again, the price of money. So it went back slightly to 1.5, let's say, and with the move yesterday, the news yesterday, the bad news, interest rate cut expectations nearly jumped to 2 for 2025. So this is just a way to see the situation where the US is right now, which is not very good. So we'll see what the market does on Monday, if the market recovers and say, okay, this coronavirus and with a little bit of rate cuts we'll be able to manage, or if it goes into something more serious. So 10:52, I have 8 minutes, let's say, to cover the markets and go to the dashboard if I want to explain a couple of things. Let me check the comments first. Okay, Cliff, we have Andrew Lewis. Trump wants his money back. Yes, that's exactly what I said. Nord Stream will reopen soon. Yeah, that's what I said about Germany, because Germany needs it. Germany and France do not love each other. All the European countries do not love each other. These countries have been at war for centuries. Ask a French what he thinks about the British, about a German. The culture. What's interesting is that in such a limited place, specifically compared to the US, the cultures are really, really different. France, UK, Germany have been making war all their history long. They have different incentives, like I said today. Specifically, Germany is about industry. The only thing left in Europe is the military industry, slightly military industry, and now France is becoming kind of a museum country, reserved for tourism. So yeah, that's exactly right, Andrew Lewis. So let's move on to the market. So what do we see here? A couple of charts, just to show you that maybe one news before. I've seen that yesterday or the day before, I don't remember, that Doge, or some are calling it Dogi, but as a French I call it Doge. But anyways, they are officially investigating the SEC for fraud, abuse, and waste. That will be very interesting to see where they're going with this. I think attacking a regulator is never a good thing, in my opinion, except, of course, if they can prove that there are some fraud, abuse, and waste. Would be interesting, but I thought that specifically in the context of markets, it was kind of a big news. Couple of things that I've noted this week about the markets. For instance, that the S&P and the Dow Jones Industrial Average are not in sync anymore. They have moved in opposite ways, opposite direction, 50 out of last 200 days, which is a major top. So I think that's interesting, and I will show you a spread between the S&P and the Dow Jones Industrial Average shortly after. Other thing interesting is that the bond and stocks correlation that some investor rely on, specifically if you are investing on a 60-40 portfolio, if you are investing in equity bonds risk parity portfolio. This is something that is critical for you, because this is where you kind of dampen your volatility and get diversification from. When bonds and stocks are positively correlated, you lose that thing, and then your portfolio is getting more volatile, and you don't get the risk profile that you are looking for. Another small chart at the bottom, which is a correlation between Bitcoin and gold. You see that it's evolving, but in a range that actually is not very significant. It's always between minus 30% and plus 40%, I would say, was the max. So it's not big, and I think that's one of the major interesting thing for including Bitcoin in a portfolio. Oh, I need to put that it's not an investment advice. It just do I have this somewhere? Yes, I do. Yes, so why would I say that? Yes, because even with a tiny portion of Bitcoin in your portfolio, you can diversify your portfolio and reduce your risk. Nobody tells you to put 20% of Bitcoin in your portfolio. That would be not advisable, but tiny, even 1 to 3%, considering the volatility of Bitcoin compared to the other asset class, will already introduce some diversification in your portfolio. So that might be interesting, but that's not an investment advice to invest in Bitcoin. That's just a comment about risk management in your portfolio. So what do I have next? So markets, obviously we have to talk about what happened yesterday. Bad data at the beginning of the day, and then news from a new coronavirus yesterday. So that's so let me put that in a bigger way. The coronavirus, and this is shown by the chart, inside chart, where you have the S&P 500 going down, and guess what? Pfizer stock going up because they will send us some new, I guess, mRNA vaccines. It's interesting that thought about this yesterday. It's interesting to think that Trump left with a pandemic. It might be returning actually with a pandemic, and at the time where JFK Jr. has been confirmed as the head of health secretary, and is considering banning mRNA vaccines. Let's say mRNA technologies. So I just, it's just the coincidences are interesting, but I stop there. Otherwise, everyone will think that I'm a conspiracy theorist. One thing maybe again about Bitcoin, we know that the liquidity, M2 liquidity in the market is a kind of advanced let's say indicator of the price of Bitcoin. And when the M2 liquidity was shrinking, Bitcoin managed to stay up, probably on the expectations that it would be introduced as a reserve for the strategic reserve by the US. But now the M2 liquidity is on the rise again. So that would be interesting to see what the impact is on Bitcoin. I still need to put my not investment advice disclaimer here. So what's next? Next week, what's next? Next week we have the Nvidia earnings, and it's totally reflected in the S&P 500 volatility term structure, where you have that spike, usually specifically in a market that is, I would say, normal. You have a slightly upwarding slope for the volatility term structure. Here you have a spike around the Nvidia earnings, which means that, considering that Nvidia has been lifting the market for more than a year now, if the Nvidia earnings are not good, this could have a significant impact on the market. So now, where do we go? We go to the new stuff, the famous dashboard, and it's 11:01. It's about kind of exactly where I expected to go. So what is this dashboard? So we'll go through the dashboard. I would like you to ask some questions if you have a few. And again, I would like to have your feedback in the comments, just to get an idea of what you find interesting. If you are not interested at all in what I have to say with this, I'm really interested to know your take, because I mean that's the kind of stuff that interests me. But I'm sorry, but it might not be interesting to everyone. So where do we start? We start with some, let me take that bigger. We start with some classical dashboard where we have, for different asset class. So I will do this for equities, bonds, commodities, and Forex, including Bitcoin, which is a bit different, but anyway, where I give some quantitative numbers, information about where the price stands, where it goes. I'm losing my voice at this time, as you can see. So you have the last price. So I'm using the ETFs for that. So the last price of the ETF, the variation of 1 week, 1 year, 5 years, the all-time high, and the things that so let's say, for instance, if you look at the S&P or Nasdaq, the Nasdaq, for instance, dropped 2.25% last week. So this week, not last week, this past week, essentially it was flat for the week and essentially went down yesterday. On a rolling 1 year basis, it's still up 90%, so nobody will complain about that. So I put the distance with the all-time highs. As long as the distance versus the all-time highs is not above 5%, I put that in green. There's nothing much to worry about. If you look at emerging markets, they are in a drawdown of compared to the all-time highs of about 15%. I think, again, that's not a big concern. If you look at the bonds, for instance, distance to all-time high, you have TLT, which is a long-term bonds ETF, which is in a drawdown of 40%. So here, the reason that I put that in red, the common, widely accepted to be in a bear market is when you're above. Excuse me. When you're above, when you lower than above 20% drawdown. So anytime you are lower than minus 20%, like this minus 40%, I'll put that in red. And what did I add more to be noticed is you have the volatility. So the price is what is happening, and the volatility is how it's happening. So I put the volatility, the 1 month volatility, and I compare it to the 1 year volatility to see where it stands, just to gauge where the activity is. So there is the absolute value of the volatility compared to the 1 year value. If it's less than 1, we're not exactly in a crisis, but I also put the change of this ratio, because when this ratio is increasing, this means that there is more activity, the risk is increasing on the asset. And I do basically the same thing for what I call the volume ratio, which is a ratio of short-term volume versus long-term volume. So when we have that increase in terms of volume, it's an increase in terms of activity on the instruments that I show, and this means something basically is happening there. So what we see here, for instance, on the equities, specifically on the S&P 500, we had the volatility ratio increasing by 6%, and the volume ratio increasing as well. So there is a little more risk, perceived risk, on the S&P compared to what we had over the last month, and it's mostly due to the last day, for instance, so yesterday. So again, it's a kind of gouging the activity on every number. So I'll take maybe a little bit more time to explain, but over the next weeks I will just go through this number, say okay, has this happening and this happening, and we'll definitely go much faster than that. So again, what we see here, we have a regain in activity on the equity side, except for European stocks, only because they close much earlier than US. So that will be, so when the news broke about coronavirus, the markets, the European markets were not were closed already, so the impact was not as much, even though the ETF is quoted in the US and was impacted. But we'll have to see what happens when the market opens on Monday in European markets. So for the bonds, I mean, we have the really difficult situation of long-term bonds, which hurt like the 60/40s, the risk parity portfolio, for instance, being when you're down in a 40% drawdown, that's obviously hurt. We have a little more activity as well. The volatility ratio is changing on the upside, and the volume is also increasing on the upside, although again it's only due to the activity that we had yesterday. So it might not be significant at this time, but this is the kind of thing that you can follow and monitor the activity with. Commodities, nothing much happening there. So the volatility ratio is increasing, but it's not doing much. Volatility ratio is increasing, volume ratios are decreasing for some of them. Not really crazy stuff there. On Forex, what's interesting is that you have the volatility ratio decreasing on the US dollar, which I will explain you. Sometimes when you have a correction like we have in US dollar, this has an impact on the volatility itself and may decrease the volatility as well. That's what's happening. Volume ratio is decreasing as well. So no, it's slightly increasing. We have more variations on the yen, for instance. Specifically in the volume, we have things happening on the forex, on foreign exchange, and we also have Bitcoin, which is really different. So it's very difficult to compare with other foreign exchange instruments, but this is where I put it for the time being. Maybe in the future I will put a specific section about cryptocurrencies. We'll see. So what's next? So here you have something a little bit more classic, which is the S&P since 2020 compared with the VIX, the volatility. So we see that, oh, Henrik Blatt is here. Guten Morgen, mein Freund. We were speaking about, that there's no love lost between the Germans. So let me tell you, let me show you. So yeah, we were speaking before you joined about, there's no love lost between Germans and French. But that's what interesting between a relationship. I address relationships on the individual basis, and the people should never be taken for their government, whatever the government is doing. Nobody thought that all Germans were crazy guys before, and there are multiple stories about this, but anyway, I would just not go there. But just on an individual basis, Henrik, we've become friends. Although he's German, but he's a very nice guy, and that's all I'm asking when I'm dealing with someone, and very helpful actually. So let's go back to volatility compared to, you see the spike yesterday on the news of the coronavirus. This was not a massive spike like the ones we've seen in 2020, but if you look at 2020, that's how it started. A small spike, the volatility easing before the big one. Usually there are some, it's like an earthquake. You have replicas before it goes into some craziness. So we'll see what happens. This will be again very interesting to monitor over the next couple of weeks. So more interesting stuff. What I was saying about the volatility ratios is, if you look here from 2024, we had a volatility spike at the beginning of August. This is where we've seen it, but the short-term volatility before the spike in early August started rising as soon as mid-July, before we got the news. So we have the volatility rising, so that would translate into the dashboard, into the volatility weekly variation going up, a sign of increased activity on the market. And then this is where, for instance, you cannot see my my mouse on the screen. I should see how I can get a pointer for that. But anyways, as soon as the short-term volatility is going above the long-term volatility, that's clear sign of stress in the market, and that's one of the reasons we have to look at this to see what's happening. And actually, the spike in early August happened after the ratio of short-term volatility versus longer-term volatility went above 1. So we were already in a situation of stress. So again, these are situations where you have to be aware of. Recently, we were in a situation where the short-term volatility was contracting quite significantly. With what happened yesterday, we had a spike in short-term volatility again. There's no panic to have at this time, unless you think that we will be hit by another pandemic. But I think that people will react differently than the first time. If people are as fearful as they were the first time, there's no hope in humans, I would say at this point. But anyway, so we'll see, if the volatility keeps short-term volatility keeps expanding, see if it's going above long-term volatility, and this is when we'll have to be really cautious at some point. So next week will be this to monitor, especially again, like I said, in the context of Nvidia earnings. We might have some volatility happening in the market. So what is this? This one is a little bit more complicated to explain. This is volatility adjusted momentum, which kind of say what would be the exposure of a portfolio based on momentum. Again, this is not an investment advice, but for instance, if you look at UUP, which is the dollar ETF. Why is it so big? For a couple of reasons. We had some momentum there, but the volatility of Forex is much smaller than the volatility of the S&P, for instance, or even gold. And this is why, so you have momentum divided by volatility. So the denominator being much smaller gives you a big weight in your portfolio just to equate the risk within your portfolio. And this is why you may see the risk adjusted momentum bigger, even though we had the momentum slightly contracting on the US dollar last week. And so you may also, wondering why it's going up when the momentum is going down, specifically for the US dollar again. Simply because when you have, some corrections, small correction, not wild correction like this, I mean, even if the momentum decreased, the numerator, the volatility decreased faster than the numerator decreased itself. And so this results in a bigger risk-adjusted momentum. I want to go back to something that might be interesting to you, which is again this chart, which is the volatility. Why is it interesting? Because for another reason, because this is most CTAs, not all of them, specifically, the turtles that take their risk allocation at the beginning of the trade and keep it as long as it lasts with a stop loss. But most modern CTAs are risk adjusting their positions, just like the risk adjusted momentum that I've shown here. And so looking at where the volatility is going tells you a bit about what the CTAs will be doing. For instance, we look at the S&P volatility at this time. So we know that the momentum of volatility was stronger, was quite strong. So CTAs are long equities at this time. But what happened, so this week with yesterday, is that the volatility increased, exactly like I've shown in the dashboard here. You see that on the S&P the volatility ratio changed, so the volatility increased. And what this means is that since the volatility increased, that's the numerator of the risk-adjusted momentum. What this means is that the risk-adjusted momentum will be smaller, not only because the momentum was slightly down, but it was kind of constant even with yesterday. But volatility being increased, the numerator increased as well, which is reducing the risk-adjusted momentum. Like we see, we have a slight drop, over the week, which is again mostly due to what happened yesterday. But why is it interesting? This will give you an idea where the CTAs and are going. If the volatility keeps going, the pressure, the risk-adjusted momentum will be lower, which means that the CTAs will have to sell some of their equity exposure, notwithstanding the momentum on the S&P. So this can give you a clue about what the CTAs, the commodity traders, advisors are doing, are trading on futures. They probably will sell very limited position at this time on equities. Maybe on Monday it will be happening. If the volatility is increasing, they will sell even before the momentum is actually going down. So I think that's maybe a little bit complicated. So I will probably go back to this, maybe do a specific section about this. There would be a lot to say about it. So maybe a last few chart before leaving you for your weekend. I like to see the markets in a relative way, and here because you have the absolute value, but everything has to be taken into context. If you look at the US dollar, for instance, I've been saying a lot of things about the fragility of the US dollar over the past week, but it's only relative to the fragility of other currencies. If you only consider forex. Now, if you consider gold, or if you consider Bitcoin, then that's a different story, but this is where we're going. So here we have the Nasdaq, the Dow Jones Industrial Average, and the Russell 2000 or 3000, well, the small caps versus the S&P. So what does it show is that the Nasdaq has overperformed the S&P, while the Dow Jones Industrial Average has consistently underperformed the S&P since 2020, as much as the small caps. There was a rebound in small caps right after the start of the pandemic, not after the pandemic, but right after the start of the pandemic, and then it went back to the regular trend. So again, which is another kind of sign of concentration in the markets towards the bigger names, the bigger index, and specifically the tech sector. Again, it's again, like I say, everything is in the numbers when you know how to look at it. So I do the same thing for European countries. You have here the Euro Stoxx 50, Germany and France, that have all been lagging since 2020. Compared to the S&P, we have a significant recovery without breaking the downtrend actually at this time. I think it's mostly based on the news that we would get to a peace agreement in Ukraine, and potentially some of the cheap Russian energy back for Europeans, but we'll see that if it breaks the trend. To be honest, I would be very surprised, because I don't see any relay of growth in Europe beside what they already have. The only thing that I believe we can expect today in Europe is that Germany going back to where it was with again renewed access to cheap Russian energy. There's no industry left basically in the other countries in Europe, and I see this move as a kind of relief, but I don't see how it could from there outperform the S&P 500 on a regular basis long term. I just don't see this. And by the way, there is a French car maker that is reinvesting in diesel engines. They were all going to electric vehicles. So the group that is managing, I think it's Peugeot, Citroën, another couple of few brands, that is called Stellantis. They announced that they are going back to develop the diesel engine, which has always been quite popular in France, thanks to the tax incentive on gas in Europe. So what is this? So that's this, similar thing is that you just cannot really compare equity indices versus the currency, knowing that the currency is printed and loses some value. So I do the same kind of work looking at the S&P versus gold. So since 2020, you see that the S&P has only increased by 6% versus gold, which is kind of insane. European stocks are down versus gold. US dollar that has been printed massively over the last couple of years is down as well. No surprise there. Well, US dollar is basically only the inverse of gold anyway. So this is where we are. I think it's much more interesting to look at charts like this. So these are the absolute charts except for currencies. Here, so where we have so the US dollar going up again, it's always relative, but what I think is the most interesting is that we have at this time, because of the carry trade, we have the US dollar and the yen that are mirroring themselves, right? So we have with Japan inflation interest rate, the yen is going up. At the same time, we have the US dollar slightly going down. So the carry trade will be again to be monitored over the next weeks and months. If the inflation in Japan is continuing to increase, I don't think that Japan will increase their interest rates. That I will see, but I don't think so, to be honest, because there's so much more to lose. This will send really a massive shockwave to the market. So let me check if you have comments about this. That's true. Not all French are pussies and not all Germans are eat bratwurst. That's true. So yeah, so if you don't have comments right now, I know there's a delay in the comments anyway. It's probably slightly late. I know a couple of you are still there, but I cannot really tell. So okay, so maybe we'll stop there. I will let you go through this and check if there is something interesting in this new dashboard. Again, I would really like to have your comments, get your take on which section should we shrink, which section should we increase. I don't think we need to increase geopolitics because it's already too long. Economy, I think it could stay at the current level and maybe keep the dashboard a little bit longer. So that's already an hour and 15 minutes. That is way more than enough for this weekend. So thank you guys. Have fun, enjoy your weekend, and see you next week. Thank you guys.